When you think of legendary investors, names like Warren Buffett and Charlie Munger might immediately spring to mind. However, there's another investor whose down-to-earth approach and extraordinary track record continue to inspire millions. Peter Lynch. Known for turning the modest $18 million Fidelity Magellan Fund into a $14 billion powerhouse in just 13 years, Lynch proved that you don't need insider secrets or complex formulas to succeed in the stock market. His simple mantra, "Invest in what you know," has resonated with everyday investors around the world. In this article, we'll explore Peter Lynch's journey, his core investment philosophy, the strategies he used to spot winning stocks, and the timeless lessons he left for anyone wanting to navigate the world of investing. From humble beginnings to Wall Street, early life and influences. Peter Lynch was born in 1944 in the United States and grew up in modest circumstances. After the early loss of his father, Lynch's family faced financial difficulties, which instilled in him a keen awareness of money and a desire to improve his situation. At the age of 11, he started working as a golf caddy at a local course. While many kids his age were simply enjoying their childhood, Lynch was absorbing every bit of conversation from the wealthy businessmen he served. Their discussions about the stock market and investments piqued his curiosity and laid the foundation for his future success. The first taste of investing. By the time Lynch reached college, he had already started investing. With the small savings he accumulated from caddying, he made his first stock purchase. One of his early investments was in an airline company during the Vietnam War, a decision based on the observation that the airline industry was booming at the time. This initial success taught him that everyday observations could lead to big financial rewards. The rise of the Fidelity Magellan Fund. In 1977, at just 33 years old, Peter Lynch was given the reins of the Fidelity Magellan Fund, a relatively unknown fund with only $18 million in assets. Under his leadership, the fund's assets skyrocketed to $14 billion by 1990, boasting an average annual return of 29.2%. Lynch's success wasn't the result of complex models. It was built on a disciplined, common-sense approach that many individual investors could emulate. His remarkable performance redefined mutual fund management and showed that investing based on careful research and personal insights could outsmart even the most seasoned professionals. Core investment philosophy. Invest in what you know. At the heart of Lynch's approach is the belief that everyday experience is a powerful tool in investing. He argued that if you love a product or a service, you might have a unique insight into its potential for growth. Rather than relying solely on expert opinions or intricate financial models, Lynch encouraged investors to observe their surroundings and pay attention to trends in their daily lives. Real-world examples, restaurants and retail. If you notice that a local restaurant is always packed, or that a particular retail store has long lines and loyal customers, these everyday observations might indicate a strong, growing business. Consumer products. When a product becomes the talk of the town, whether it's the latest tech gadget or a popular clothing brand, it could signal an opportunity for investors to get in early. This straightforward approach empowered ordinary investors to look beyond Wall Street's charts and reports and trust their own experiences. The magic of the 10-bagger. One of Peter Lynch's most famous contributions to the investment world is the concept of the 10-bagger, a stock that increases tenfold in value. Lynch sought out companies with the potential to deliver explosive growth. Here's what he looked for: steady earnings, growth. Companies that consistently increase their earnings are more likely to reward shareholders over time. Low debt levels. Financially healthy companies with manageable debt can better navigate economic downturns. Competitive advantages. Businesses with a unique product, strong brand, or technological edge can dominate their markets. Undervalued stocks. Sometimes the market overlooks a company's potential. These undervalued stocks, once recognized, can yield massive returns. By focusing on these factors, Lynch was able to identify hidden gems that eventually turned modest investments into windfalls. Breaking down stocks, Lynch's 6 categories. To manage risk and understand the different types of companies, Peter Lynch divided stocks into 6 distinct categories. 1. Slow growers. These are large, established companies with modest growth, often found in industries like utilities or consumer staples. They may not offer explosive returns, but provide stability and regular dividends. Second, stalwarts. Reliable companies with steady growth, such as Coca-Cola and McDonald's. They are less volatile and offer consistent performance over time. Third, fast growers. Smaller companies with rapid earnings growth that have the potential to become 10-baggers. These are the stocks that can multiply your investment many times over. 4. Cyclicals. Companies whose fortunes rise and fall with the economic cycle. Industries like automotive and airlines fall into this category, where performance is closely tied to broader economic conditions. 5th, turnarounds. Businesses that are struggling but have the potential to recover dramatically. Investing in turnarounds can be risky, but the payoff can be substantial if the company manages to revive its fortunes. 6. Asset plays. Companies with hidden value in their assets, such as real estate, patents, or natural resources, that is not fully reflected in their stock price. This system allowed Lynch to tailor his investment approach to each category's inherent risks and rewards. Focusing on fundamentals over hype. In an era where headlines and market predictions can be overwhelming, Lynch maintained a laser focus on the fundamentals of a business. Rather than being swayed by daily market fluctuations or expert opinions, he honed in on key metrics like earnings growth, debt levels, and the company's overall business model. His belief was simple: if a company's earnings continue to grow, its stock price will eventually follow, regardless of short-term volatility. This long-term, research-driven approach meant that even during market downturns, Lynch saw opportunities rather than reasons to panic. For him, temporary dips in stock prices were chances to buy quality companies at discounted rates. Real-world success stories, Dunkin' Donuts and Taco Bell. Peter Lynch's knack for spotting trends in everyday life led him to invest early in companies like Dunkin' Donuts and Taco Bell. At a time when many investors were skeptical about the potential of the fast food industry, Lynch saw the consistent popularity of these brands as a sign of robust business models and strong customer loyalty. The Ford example. Another notable example was his investment in Ford. When market sentiment was overwhelmingly negative, Lynch recognized that Ford's fundamentals were solid. By buying during a downturn, he positioned himself to benefit immensely when the company rebounded, demonstrating his contrarian strategy, buying when others are fearful. Timeless lessons for today's investors. Even decades after his retirement, Peter Lynch's investment philosophy remains as relevant as ever. Here are some key lessons every investor can take away from his approach. 1. Start small. You don't need to invest a fortune to get started. Consistent, small investments can grow significantly over time through the power of compounding. 2. Trust your observations. Your everyday experiences can provide valuable insights. Pay attention to the products and services you use and the trends you see in your community. 3. Think long-term. Rather than chasing short-term market trends, focus on companies with solid fundamentals and hold them for the long haul. 4. Do your homework. Thorough research is essential. Understand a company's financial health, competitive position, and growth prospects before investing. 5. Embrace market downturns. Instead of panicking during market dips, see them as opportunities to buy quality stocks at lower prices. Lessons to remember. Carrying forward the legacy. Peter Lynch revolutionized investing by proving that success doesn't require complicated theories or insider information. His simple yet powerful approach, investing in what you know and focusing on long-term growth, empowered countless individuals to take control of their financial futures. As you build your investment strategy, remember Lynch's words: invest in what you know. Look around you, trust your instincts, and do your homework. By following these timeless principles, you can navigate the ever-changing world of investing with confidence and perhaps even uncover your own 10-bagger along the way.